Have you ever stood on a dock and watched one of those massive multi-level container ships trying to turn around?
Oh, yeah. In a narrow harbor, it's agonizingly slow.
Right, from the shore, it almost looks like nothing is happening at all. The engines are groaning, the water is churning, but they're barely moving.
But beneath the surface, there is this immense, calculated exertion of mechanical force.
Exactly. And today, for this deep dive, we are looking at the corporate equivalent of that exact maneuver. Welcome in, by the way.
Glad you're here with us.
We are cracking open Teva Pharmaceutical's Q2 2026 earnings report to see how a historic generics giant attempts this high-wire financial balancing act mid-ocean.
And it really is mid-ocean.
Yeah, so our sources today are the official financial press release, the raw data tables, and management's commentary. We're looking squarely at the mechanics of what they call their pivot to growth strategy.
That container ship visual you used is incredibly apt for Teva. Turning an enterprise of this scale is never just a quick flick of the steering wheel.
No, definitely not.
Teva is historically recognized globally as a generics powerhouse, right? They built an empire by manufacturing those affordable off-patent medicines you see stocking pharmacy shelves everywhere.
The cheap stuff.
Exactly. But that traditional economic model is undergoing a massive stress test right now.
Which is why, whether you are holding Teva in your retirement portfolio or tracking the broader biotech sector, or you're just fascinated by the sheer physics of how a multi-billion-dollar ship pivots.
Pivots from volume-driven manufacturing to high-margin innovation.
Right. The mechanics here are just fascinating. So let's look at the numbers. On the surface, the top-line revenue looks, well, frankly, a bit stagnant.
A bit stagnant is a nice way of putting it.
Yeah, Q2 2026 total revenues came in at $4.1 billion, which is a 1% decrease in U.S. dollars compared to the same time last year.
And a 3% drop when you factor in local currencies.
Right.
Now, in a typical corporate environment, a top-line revenue drop like that sets off immediate alarm bells.
Oh, for sure. Investors panic.
Yeah, the market instinct is to assume the business is shrinking, losing market share or just failing to execute on its sales strategy.
But when you actually read the data tables in the source material, that 1% drop is hiding a massive structural mutation.
It really is.
The drag on their revenue isn't systemic across the whole company. It's almost entirely isolated to their legacy business. Global generic revenues dropped 15% in local currency.
15% is a huge hit.
Huge. And the U.S. market took a particularly heavy hit because of new competition for lenalidomide capsules.
Right, the generic version of the cancer drug Revlimid.
That's the one.
Which perfectly illustrates the brutal structural reality of the generic drug business. I mean, to understand why Teva is pivoting, you really have to understand the patent cliff.
Right, break that down for us.
So when a pharmaceutical company invents a new drug, they're granted a patent, which is basically a legal monopoly for a set number of years.
They get to set the price.
Exactly. But once that expires, it's open season. A company like Teva steps in, reverse engineers the pill, and sells it at a fraction of the cost.
Which I imagine is incredibly profitable for a little while.
For a brief window, yeah. But the barrier to entry is so low, soon, 5 other generic manufacturers are making the exact same pill.
So you just end up competing purely on price.
Precisely. The margins become razor thin. What was once a river of cash turns into a trickle.
Okay, so the generics business is essentially like printing public domain books. Anyone can print copies of Shakespeare.
Right.
So the only way to win is to use the cheapest paper, the cheapest ink, and sell massive volumes of it.
That is a brilliant way to put it. You are fighting over literally pennies per unit. And that is a very dangerous game when global supply chains get disrupted or inflation drives up your manufacturing costs.
Meanwhile, the innovative side of the business, the patented drugs, that's like holding the exclusive ironclad copyright to Harry Potter.
Yes, you control the pricing, you control the supply, and the margins are vastly superior.
And that is exactly what management is actively prioritizing mid-voyage. They are deliberately letting the low-margin public domain books, slide off the deck to make room for these high-margin exclusive copyrights.
And the numbers on those exclusive copyrights are wild.
Seriously wild. Teva's 3 key innovative brands didn't just grow, they surged by 43% collectively in local currency.
Generating over $1 billion in revenue just for this quarter.
Yeah. Austedo, which treats movement disorders, hit $696 million. That's up 40% year over year.
Incredible growth.
Then you have AGOV, their migraine treatment, which brought in $244 million, up 56%. And UZED, why schizophrenia treatment, reached $77 million, growing 43%.
The contrast is just stark. You have a legacy division shrinking by 15% and an innovative division growing by 43%.
Yeah.
This changing product mix, it fundamentally alters the financial DNA of the entire company.
So I'm understanding this right. This shift in the cargo is what explains their profitability numbers. Because total revenue went down 1%, but they reported that their non-GAAP gross profit margin actually went up from 54.6% a year ago to 55.4% today.
Right.
So they are bringing in slightly less cash overall.
Mm-hmm.
But because these new patented drugs require roughly the same amount of plastic and chemical filler to manufacture as the cheap generics.
They get to keep a much bigger slice of every dollar they make.
Right.
The physical manufacturing cost of a pill is practically negligible compared to its retail price when it's under a patent. So when Austedo grows by nearly 40%, a massive percentage of that new revenue falls straight through to the gross profit line.
So the ship is physically lighter, but the cargo on board is exponentially more valuable.
That's the pivot. Management sees this working so clearly that they even raised their full-year 2026 outlook for all three of those key brands to a combined target of around $3.7 billion.
Wow. Okay, but that leads me to wonder about the bottom line.
Yes. The
Yeah.
GAAP numbers.
Yeah, because if they are keeping a bigger slice of every dollar and the highly profitable drugs are booming, you'd assume they'd be swimming in net income for the quarter.
Yeah.
But their official accounting tells a completely different story.
Oh, very different story.
Teva reported a GAAP loss of 49 cents per share. They posted a quarterly operating loss of $231 million.
Right.
And their U.S. segment alone swung to a $76 million loss, compared to a nearly $700 million profit in the exact same quarter last year.
Yeah, it's quite a swing.
What is creating this massive disconnect between the booming margins and the official losses?
Well, the disconnect comes down to how accounting rules treat massive scientific investments. You mentioned a GAAP loss.
Right.
GAAP stands for Generally Accepted Accounting Principles. It's the standardized rule book that companies must follow to report their financials.
Okay.
Whereas non-GAAP numbers are adjusted by management to strip out one-time, unusual events so investors can see how the core business is actually running day to day.
So the GAAP numbers are pulling in some massive one-time shock to the system.
Exactly.
And looking at the sources, that shock is clearly their $700 million bet on a company called Emalex Biosciences.
That's the one. See, to fuel this pivot to growth strategy, Teva has to step up innovation. They can't just rely on the 3 exclusive drugs they currently have.
Right. Those patents will expire eventually, too.
Exactly. They need the next generation of treatments to replace them.
So the sources show they recorded a $726 million expense in Q2 related to this acquisition, and $724 million of it was classified as in-process R&D or IP R&D.
Yep.
This one purchase dragged their non-GAAP diluted earnings per share all the way down to just 2 cents.
It basically zeroed out their quarter.
So what exactly is in-process R&D?
Well, when a pharmaceutical giant buys a smaller biotech startup, they aren't usually buying factories, inventory, or physical real estate.
Right, they're buying the science.
Exactly. They are buying the intellectual property and the clinical trials. Under standard accounting rules, if that drug is still in testing, if it hasn't been fully approved by the FDA and isn't generating revenue yet, it is considered in process.
Okay, that makes sense.
But because there is a risk it might fail, regulators force the acquiring company to write off almost the entire purchase price immediately as an expense.
So it's like buying a house that's still under construction,
Yeah.
but the bank makes you report the entire purchase price as a total loss on this year's taxes.
Even though you're going to rent it out for a fortune next year.
Wow, okay.
That is a perfect way to visualize it. It creates an incredibly ugly quarter on the official GAAP ledger, but it really reflects the acquisition of a long-term strategic asset.
I have to push back on the asset itself, though.
Oh.
Yeah, they wiped out their quarterly operating income to acquire Imalex's primary drug, ecopipam, which is a therapy for pediatric Tourette syndrome.
Right.
I have to imagine this isn't a guaranteed slam dunk. Are they taking a $700 million gamble on something that might not even work?
Well, in the pharmaceutical business, there are no guaranteed slam dunks until the FDA hands you an approval letter.
Fair enough.
It is always a calculated risk. But absorbing this kind of acute, short-term financial pain is often the only mechanism to secure a long-term monopoly.
Because Tourette syndrome is a pretty specialized area.
Highly specialized. It's a neurological condition with a massive unmet medical need. Currently available treatments often come with severe side effects, like significant weight gain or other neurological issues.
Oh, wow.
Ecopipam is what they call a first-in-class investigational therapy,
Meaning what exactly?
meaning it attacks the disease through a completely new biological pathway.
Okay, so if it works, there's nothing else quite like it on the market.
That is the goal. Teva already submitted a new drug application to the FDA in June 2026. If they secure that approval, they own that market space entirely.
So they are willingly trading a painful quarter on paper today for a franchise that could generate billions over the next decade.
Exactly.
And it's not just Ecopom. The sources detail a really aggressive acceleration of their clinical pipeline. But again, these medical terms are pretty dense.
They definitely can be.
Yeah. They highlight an olanzapine long-acting injectable for schizophrenia. They note the European Medicines Agency just accepted their application, and they are targeting a U.S. launch in late 2026.
Yeah.
What makes a long-acting injectable so much more valuable than just giving a patient a daily pill?
So the mechanism of delivery here is actually life-changing, both clinically and unfinancially. Olanzapine is a well-known, highly effective antipsychotic medication.
Right.
But in schizophrenia, medication compliance is one of the biggest hurdles. A patient taking a daily pill might feel better, decide they don't need the medication anymore, miss a few doses, and suffer a severe relapse.
Oh, that makes a lot of sense.
Yeah, so a long-acting injectable, or LAI, is administered by a doctor once every month, or sometimes even every few months.
Oh, I see. It completely removes the burden of daily habit from the patient.
It creates systemic stability for the patient, which prevents tragic hospitalizations. And from a financial perspective, it creates highly predictable, recurring revenue for Teva.
Right, because you are locking in a continuous care model.
Exactly.
Yeah.
Which is why UZDY, their other schizophrenia injectable, is growing so fast.
That makes total sense. Then the sources mentioned something partnered with Sanofi called an anti-TL1A compound, or duvakitug.
Ah, yes, Duvakitug.
Yeah, I definitely don't have a medical degree. And the press release casually lists that they are initiating studies for this one drug across multiple severe conditions. They list ulcerative colitis, hidradenitis suppurativa, and Crohn's disease.
Right.
What exactly does an anti-TL1A compound do, and why is management calling it a pipeline in a product?
So this is the holy grail of modern biotech strategy. TL1A is a specific protein in the human body that regulates inflammation.
Okay.
In autoimmune diseases, the immune system gets confused and attacks the body's own tissues, causing severe inflammation.
Right.
Hidradenitis suppurativa, for instance, is a chronic, incredibly painful skin condition. Crohn's and ulcerative colitis attack the digestive tract. They look like completely different diseases on the surface, but they share a similar underlying inflammatory trigger.
So instead of inventing 3 completely different drugs for the skin and the gut, you just invent one biological mechanism that blocks the TL1A protein, effectively turning off the main inflammation switch.
Precisely. That is a pipeline in a product. Once you have the compound, you just run clinical trials to prove it works on various inflammatory diseases.
Wow. So if it hits, your return on investment is astronomical because one single drug suddenly serves 5 different patient populations.
Exactly. And this brings us back to the financial reality. Running multiple phase 3 clinical trials simultaneously across all those diseases is extraordinarily expensive.
Which means Teva is burning through hundreds of millions in R&D cash to secure these future monopolies.
Right.
But to fund that kind of cutting-edge science, you need an ironclad bank account today. How is Teva actually paying for this mid-ocean pivot without capsizing?
Well, you cannot execute a scientific transformation if the corporate foundation is crumbling. The sources make it very clear that alongside the clinical trials, Teva is executing a brutal, calculated restructuring of their balance sheet to afford this.
We definitely see that with the Teva Transformation Program. They are aiming for $700 million in net savings and targeting a 30% non-GAAP operating margin by 2027.
Very aggressive targets.
Yeah. And they're also actively seeking to divest their API business. What is API and why sell it?
API stands for active pharmaceutical ingredient. It is the raw chemical manufacturing side of the business.
Okay.
Think of it like a bakery selling off its flour and sugar milling operation so it can focus purely on baking high-end branded wedding cakes.
Oh, that's a great analogy.
Yeah, API is a scale business. It's not an innovation business. By selling it, Teva raises capital and sheds more of that heavy, low-margin cargo we talked about earlier.
That perfectly tracks with the strategy.
Yes.
But there is another structural move detailed in these sources that feels purely administrative, yet management highlights it prominently.
The stock listing change.
Yeah. Teva is replacing its ADS program, American Depository Shares, with a direct listing of their ordinary shares on the New York Stock Exchange in September 2026.
Right.
Their shares on the Tel Aviv Stock Exchange stay the same. Why does a shift from an ADS to an ordinary share matter to anyone other than, a corporate lawyer?
It sounds like trivial financial plumbing, I know, but it is actually a massive lever for corporate stability.
Really? How so?
Well, Teva is an Israeli company. For decades, American investors traded Teva through an ADS. An ADS is essentially a certificate issued by a U.S. bank that holds the foreign stock in a vault.
Okay.
It's a convenient workaround for retail traders. However, many massive institutional investors, specifically major U.S. index funds, have strict internal bylaws that prevent them from holding depository receipts.
Oh, wow. So by remaining an ADS, Teva was essentially locking its own stock out of the biggest pools of passive capital in the world.
Exactly. Trillions of dollars sit in passive index funds run by firms like Vanguard or BlackRock. By transitioning to a direct listing of ordinary shares on the New York Stock Exchange, Teva makes itself eligible for those indexes.
And when a stock gets added to a major index, millions of retirement accounts are automatically forced to buy it.
Right, which creates a massive, stable baseline of shareholders. It smooths out the volatility of the stock price, which in turn makes it cheaper and easier for Teva to raise money in the future.
It effectively rewards the shareholders who are willing to stick around for the long-term pivot.
Exactly.
And you can see the broader financial markets responding to this house cleaning. Earlier, we talked about the GAAP net loss from the Emalex acquisition.
Yeah.
But if you look at their cash flow statement, Teva generated $622 million in free cash flow for the quarter.
Which is arguably the most important metric for a company in transition.
Yeah.
Earnings per share, as we saw with the R&D write-off, can be heavily distorted by accounting rules. But free cash flow is undeniable reality.
It's the actual cash left over in the bank vault after the factories are run, the employees are paid, and the clinical trials are funded.
Right. Generating $622 million in a single quarter proves the underlying engine is still incredibly powerful.
It also explains why the credit markets are warming up to them. Because during this exact same quarter, the Fitch rating agency officially raised Teva's corporate credit rating back to investment grade, hitting BBB.
Reclaiming investment grade status is a massive milestone.
Why is that so crucial?
When your credit rating improves, the interest rates on your corporate debt go down. It literally costs Teva less money to carry its debt, freeing up even more of that cash flow to pump right back into the pipeline in a product trials.
So every single move, the debt reduction, the shift to ordinary shares, the divestiture of API, it's all engineered to build a fortress-like balance sheet capable of withstanding the inherent volatility of biotech research.
It really is a fascinating study in corporate mutation. We are watching a company deliberately harvest the fading but still massive cash flow from its legacy generics business to bankroll an incredibly expensive pivot toward innovative neuroscience and immunology.
They are tossing the cheap public domain books overboard to make room for exclusive copyrights.
Yep.
And the underlying cash flow numbers prove the strategy is holding water, despite the messy GAAP accounting on the surface.
The transition is working. But analyzing this report raises a broader, almost uncomfortable question about the ecosystem.
No.
If a historic generics powerhouse like Teva is strategically shrinking its footprint in the U.S. generics market because the margins are simply too brutal to sustain,
Right.
who is going to manufacture the cheap, everyday medicines that the global healthcare system fundamentally relies on a decade from now?
Wow, that is the hidden consequence of this pivot, isn't it?
It is.
The economics of manufacturing basic generic antibiotics or blood pressure pills just don't work for the giants anymore, which leaves a dangerous vacuum. We absolutely need the innovative treatments for schizophrenia and Crohn's disease tomorrow, but hospitals run on that cheap, low-margin cargo today.
The top of the healthcare pyramid is seeing breathtaking innovation, but the foundational layer, the essential medicines, is being hollowed out by these exact same economic pressures.
We invite you to mull over that tension between the drive for high-tech healthcare innovation and the quiet decay of generic accessibility. It's a dynamic that will undoubtedly shape the future of global medicine. We'll keep our eyes on the data to see how this mid-ocean pivot progresses. Until next time, keep digging deeper.